The possibility of a conflict between Iran and the United States is not just a geopolitical issue, it's a major financial event that can shake global stock markets within minutes. Investors around the world closely watch such tensions because history shows that war, especially in the Middle East, can trigger immediate and sometimes unpredictable reactions in the stock exchange. First, let's understand the most immediate impact: market fear and volatility. Whenever news of military escalation breaks, investors tend to panic. This creates what's called a risk-off environment, where people start selling stocks and moving their money into safer assets like gold, bonds, or the US dollar. As a result, major indices often drop sharply in the short term. In fact, recent tensions have already caused stock markets in different regions to fall and volatility indexes to spike significantly. Business standard. One of the biggest reasons behind this reaction is uncertainty. Markets hate uncertainty more than anything. When investors don't know how long a conflict will last or how severe it could become, they reduce exposure to risky assets like equities. Analysts have even warned that markets may react negatively in the near term as geopolitical risks increase and investors reassess their positions. Deccan Chronicle. However, the story doesn't end there. Interestingly, not all sectors suffer equally. In fact, some industries actually benefit from war. For example, energy stocks often rise sharply during conflicts involving Iran. Why? Because Iran is located near the Strait of Hormuz, one of the most critical oil supply routes in the world. Any disruption in this region can push oil prices higher, which boosts profits for oil and gas companies. Recently, oil prices surged above $100 per barrel due to conflict-related supply disruptions, highlighting how sensitive energy markets are to geopolitical tensions. The Guardian. Another sector that tends to perform well is defense and military-related companies. During times of war, governments increase spending on weapons, technology, and security systems. This leads to higher revenues for defense contractors. In contrast, sectors like airlines, tourism, and transportation usually decline because rising fuel costs and safety concerns reduce travel demand. Now let's talk about the U.S. stock market specifically. Surprisingly, despite ongoing tensions, U.S. markets have shown resilience in some cases. For example, the S&P 500 has only seen limited declines compared to other global markets, partly because of strong corporate earnings expectations. This shows that while war creates fear, strong economic fundamentals can sometimes cushion the impact. Market watch. But there is a bigger risk that investors should not ignore: inflation and recession. Rising oil prices increase the cost of transportation, manufacturing, and daily goods. This leads to inflation, which reduces consumer spending power. According to economic experts, prolonged conflict could increase the chances of a recession due to higher energy prices and slower economic growth. Business Insider. Another critical factor is the duration of the conflict. If tensions are short-lived and quickly resolved, markets often recover just as fast. In fact, we've seen cases where markets bounce back strongly after initial panic. But if the conflict drags on or escalates further, it can lead to a prolonged bear market with sustained losses. Global markets also react differently depending on their exposure to oil imports. Countries that rely heavily on imported oil, such as many Asian economies, tend to suffer more because rising energy costs hurt their trade balance and economic stability. In summary, an Iran-US war can have both negative and positive effects on the stock market. In the short term, expect fear, volatility, and potential market drops. In the medium to long term, the impact depends on oil prices, inflation, and how long the conflict lasts. While some sectors like energy and defense may benefit, others like travel and consumer industries may struggle. For investors, the key is not to panic but to stay informed and diversified. Because in times of global uncertainty, smart strategy matters more than ever.